Okay, good morning. I guess our ranks have thinned, maybe the cold weather. Today, we're finishing up Chapter 2. I'll tell you right now, not to be discouraging, but we have a ton to do today. But whatever homework problems we don't get through, I do have videos lined up to send out, so I'll send those out this afternoon. So you still, it's just a really meaty chapter, and like I said, chapters 1, 2, and 3 are fundamental to the rest of the course. So extra time you put in these first few weeks will pay off down the road. If you've not signed in yet, sign in to Learning Catalytics. There is a question there. Again, it's participation today, so you'll get credit for whatever answer you answer. Due this week, pretty simple, Chapter 2 homework. It's in my accounting lab. It's there, and again, so we're going into Chapter 2, and we're going to start with in Learning Catalytics, there is a question right now. So we'll leave this open for probably about, 20 seconds, 30 seconds or so. So get yourself logged in. And we're looking at this we did on Monday. Which of the following transactions will increase one asset and decrease another asset? So I think when we started here, we had a lot of right answers. Yeah, so we're running around 70% correct on this one. Okay, so which of the following will increase one asset and decrease another asset? Pardon me? Yeah, you put that in Learning Catalytics. Yeah. Okay. Okay. Okay, so this one, yeah. Pardon me? I pushed the questions out. Yeah, so did you answer this one? Good. Okay, you're right where you need to be. Okay. Okay, so we're going to close this one in about 5 seconds. I'm going to talk about the answer and then you close it when I'm done. Okay, so the answer on this one is the purchase of equipment for cash. And when we talk about increasing one asset and decreasing another one, as I go through the answers, the purchase of office supplies on account. If we purchase office supplies on account, we're going to be debiting office supplies, which is an asset, so we're increasing an asset. But the other side of that transaction, if we purchase something on account, that's accounts payable, which is a liability. So we're increasing an asset and increasing a liability in answer A. Answer B, the performance of services on account. If we perform services on account, we're increasing service revenue, which is an equity account, and we're increasing accounts receivable, which is an asset. So that's not right because it's not two assets. Answer D, the performance of services for cash. Answer D is not correct because we get cash, so we're increasing cash, but we're also increasing service revenue, which is an equity account. So D can't be correct. So hold off on closing it for the moment. Okay. So if you're just joining us, you have about 10 seconds left. We're going on to another question. But the answer is purchase of equipment for cash. I cannot tell you how important it is to be able to identify whether something's an asset, a liability, and then for right now, equity, but then equity splits into revenues and expenses, and then common stock and retained earnings and things like that. And we'll have some more practice with that today. So let's close this. We're going to go to another one. Now, this one in Learning Catalytics, you type like a one-word answer. I want you to type in the example of an asset. Okay, so you're going to type in a one-word answer, an example of an asset, just any asset you can think of. Okay, we're going to close this one in about 10 seconds or so. But you want to make sure you type in a one-word example of an asset. We have most answers in. Okay, remember it's participation based. You type in your word answer, hit submit. When you enter your answer, Haley, can you type in an asset because I want to show the screen. When you type in your answer, the thing that you're watching for is it tells me I responded to this question, your response was hidden, and now it says your response has been hidden for privacy. So you're looking for that. You have to make sure you get that. What I see happens with people is they'll put their answer in, and then they won't hit submit, or they hit submit and don't wait long enough, and they switch over to a different app to get a text message or whatever, and so their answer does not submit. Once you see that screen that it's been hidden, you are good. It's received your answer, but you have to see that. Okay, let's close this one. Okay, example of an asset. So let's look at cash. Cash is the first one I think of. If I had to answer, I would have answered cash. We see land. Okay, so let's talk about some account names we might and might not see. The word accounts, that is not an asset. That is a type of structure that we use to compile all our transactions in. So an example of an account would be cash. Another example of an account would be land. Another example would be inventory. Another one would be accounts payable. So accounts is not an asset. We're not going to, when we look for account names, you're typically not going to see an account called TV. You'll see an account called equipment, if indeed your company does have TVs. So house, you would call that building in accounting terms. Receivable is typically accounts receivable or notes receivable. We can certainly, building supplies. Property is usually not property. Property is going to be land, buildings, equipment, something like that. So that's good. Stock. Stock would also not be listed as an asset. I know the idea here is that it's technically an asset, but in terms of account names, we have, if we buy an investment in the stock of another company, it's called investment in stock or investment in wherever, okay? So that's the asset, okay? So we're not going to see an asset called stock. We would see an asset called investment in stock or investment in whatever company. And then our own stock that we've issued is called common stock, and that's an equity account. Okay, that was fun. So let's do one more. And I'm not sure if it's going to take two answers, so we'll see what we get for 2 words. Yeah. Okay. Give an example of a liability. So we'll just play along, see how this goes. Is it showing up quick? Okay, I see it. Yeah. Okay, that's good. We can get it. Okay. Okay, another 10 seconds or so to get your answer in. They had told me that you could submit 2-word answers now, and I'm not sure how you do that. Can you put like quotation marks around it and see if that makes a difference? Yeah, well, why don't you try it? You could do it again. We'll see if it shows up like that. Oh, okay. But your hyphen probably took 2. Did the hyphenated one come through? Okay. 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 Okay, good. So two, if you want to enter two, we just learned something this morning. If you want to enter 2 words, you put quotation marks around them. Okay, so if you have a two-word answer, and if you've already put your answer in, you don't need to do that. So we're going to have about 10 more seconds on this one, and then we're going to close it. Okay, do you want to close it? Sorry. I know you're doing 50 things at one time. Okay, so the most common answer should be accounts payable, and some of this is because of that 2-word thing that we just figured out now. Accounts payable, notes payable. Yeah, it's hard. Okay, unearned revenue is a liability. I'm trying to match up the words with the 2 words here. So unearned revenue is a liability. Oh, that's clever. Accounts payable with no space. Long-term debt is a liability. Loans payable is a liability. Borrow is not, but I'm not sure, and I don't even know what word you put with that to be a liability. Expenses are not a liability. So expenses is, I can't think of a liability with an expense in the title. Unearned revenue, accrued salaries could be a payable, but I don't see that. So yeah, accrued liability. Yeah, accrued salaries, accrued taxes, something like that. Okay, so very good. Okay, so let's go back to, you'll quit sharing and I will start. So what we're going to do now is we're going to start with the homework problem. We had left off yesterday, we were talking about this idea of accounts and increasing and decreasing, and we went through the example. So now we're going to do exercise 2-2. And exercise 2-2, it tells us that Kathy's catering began with cash of $15,000, and then Kathy bought supplies for $4,400 on account and paid $7,500 for equipment. And we have 2 questions to answer. The first question is, how much in total assets does Kathy have? Okay, and how much in liabilities does Kathy owe? So we're going to walk through this and pick out what's important to us. So we're not doing journal entries. We're not recording 2 sides. We're simply answering what's being impacted in assets and what liabilities are being impacted. So how much in total assets does Kathy have? First of all, first thing, we're asked how much in total assets. And cash is an asset. It tells us that they began with cash of $15,000. It's pretty common to have a beginning balance. You start the period, you have cash left over from last period. So we start with $15,000. And then the next thing is Kathy bought supplies for $4,400 on account. When I buy supplies on account, I'm getting an asset, I'm getting supplies, so my supplies are increasing. So the asset is supplies. And then as a separate note, because we've got to answer it for Part B, liabilities would have increased as well. If I go buy supplies on account, I'm getting supplies, and I'm also increasing what I owe to others. Okay, next, Kathy paid $7,500 for equipment. Now this one's the tricky part of this, and this is what people will question the most as to doing the homework. So this is what you need to pay attention to. When we paid $7,500 for equipment, what happens there? We paid $7,500, we paid out cash, so cash went down by $7,500, an asset. But the other thing in this transaction is the equipment. And the equipment, we got equipment, so equipment went up, and equipment is an asset. So cash is going down, equipment's going up, so the net impact, you add $7,500 to assets, subtract $7,500 from assets. So it kind of cancels each other out. So those are all the numbers that we have in this problem. We have the beginning balance of cash. When we're looking for assets, we have supplies, increased assets, and then we have cash, decreased assets, and the computer or equipment increased. So what we see then, how much in total assets does Kathy have? Well, the answer is going to be, let me go back here. Okay, so when we talk about how much in total assets does Kathy have, we have the beginning balance of $15,000. We have the supplies we bought for $4,400. We subtract the $7,500 cash that we paid for the equipment, and we add the equipment for $7,500. So what we end up getting, okay, $15,000 we started with. $4,400 was the supplies that we bought. Assets went up. $7,500 was that equipment we bought. $7,500 was the cash we spent. So the answer for how much in total assets does Kathy have, the answer is $19,400. That is the total assets. Okay? And the thing that trips people up the most is that second transaction where we're buying equipment for cash. We're buying equipment for cash, so we have assets increasing and decreasing at the same time. So we add and subtract that. Commonly, people just want to add the $7,500 and forget to subtract the $7,500 for the cash spent. So that's the answer for A. Then for B, B says how much in liabilities. There's only one liability listed there at all. That was when we bought those supplies on account. That's accounts payable, $4,400. So the answer for B is going to be just simply $4,400. There's no beginning balance. There's no other liabilities. We have $4,400 in liabilities. Well, the question is why the $4,400 doesn't cancel out like the $7,500. Let me go back to this slide, show you. Okay, so the reason the two cancel, our question, so the question A is about assets, okay? So what's the impact on total assets? So in $7,500, we had an asset go up and an asset go down. Okay, so that's why they cancel each other out. But for the supplies on account, when we buy supplies on account, we're getting an asset and we're increasing liabilities. We're not paying cash. We're getting the supplies and we're signing an IOU basically when we buy on account. So in that case, we're increasing assets and increasing liabilities. Okay? Make sense then? Okay. And then, you know, a month down the road when we pay that debt, then liabilities will decrease and cash will decrease too. I mean, but we're not paying it. We're not worried about paying it right now. We bought it on account, so we increase the liability and we increase an asset. But the second transaction, we're increasing assets, decreasing assets. That's why. Okay, exercise 2.5, just wanted you to know it's a quick little exercise, more examples of increasing assets, increasing liabilities, etc. I'll send the video out for that one this afternoon. Okay, so let's try one of these. Let's try the increasing assets, liabilities, equity accounts. So a company paid cash for an amount owed to a creditor. This transaction decreased cash, and what else did it do? What's the other side of it? This is in Learning Catalytics, so you'll be answering this question. Okay, company paid cash for an amount owed to a creditor. This transaction decreased cash, and what? How are we doing on the number? Okay, so we've got about 15 people who need to get your answer in. Remember that you should be entering your answer and hitting submit, and you should see that screen that says your answer's been hidden. We're going to close this in about 5 seconds. It is participation, so you need to answer to get the credit. Okay, and the answer is it decreased liability. So let's talk about what happened. A company paid cash for an amount owed to creditors. So cash went down. Cash is an asset, so it went down. And the other side of this is we had previously owed it. So this was a debt. This was a liability we owed. When we pay a debt, it's going to decrease our liability. So we're decreasing cash, we're decreasing our liability at the same time. Okay, so then we're going on to another homework problem now. Okay, exercise 2-3. Exercise 2-3 says that Dora opened a medical practice. The business completed the following transactions. So we have a whole series of things that happened. And the question is, after these transactions, how much cash does the business have to work with? Use a T account to show your answer. So there's a couple things going on in here. We'll get to the T account at the very end, and we'll start talking about what a T account is. But the question for this problem is how much cash? That's the key in this question. It's not asking about liabilities. It's not asking about equity. It's not asking us to do journal entries. It's asking us for how much cash the business has. Okay? So that's what we're looking at. So we are going to look at every one of these transactions, simply looking for the impact on cash or not. Maybe it won't impact cash. So that's how the lens that we're going to use to look at these. So July 1st, Patel invested $60,000 cash to start her medical practice. The business issued common stock to Patel. Okay, so remember, we're doing this always from the standpoint of the business, and the business is separate from the individual. So when I see July 1st, invested $60,000 to start the medical practice, what's happening there? Well, what's happening there is the business is getting $60,000. And the business is issuing common stock, but that's an equity, and we're not interested in the equity in this particular problem. We're looking at what impacted cash. So when I look at that, cash increased by $60,000 for that first transaction on July 1st. So I'm just going to make a note of what's happening to cash as I go. So cash increased $60,000 on July 1st. Okay, next transaction down. Purchased medical supplies on account totaling $12,000. We purchased medical supplies. So we got medical supplies, but we purchased on account. And okay. No. Do you want a pair of headphones to plug in? No, you don't leave. Oh. Okay. At least you weren't on video for this. Yeah. Okay. You know what's interesting about that? Just to see what I've got on mine? This is what I do for mine because of that same issue, because I can't get rid of it, so yeah. Okay, so purchase medical supplies on account. There is no cash involved there because when the word's on account, if we purchase something on account, we're saying, I owe you, I'll pay you later. We're talking about on this date, did any cash exchange hands? No, it did not. So there is no cash involved in that second transaction. Okay, next one. Paid monthly office rent of $4,700. Okay, so we have office rent, but it said the key word here is paid. We paid. That means cash went out, okay? So in that case, Cash went out, $4,700, so I put a minus sign in front of it. I could put brackets around it. But we have cash decreasing by $4,700 for July 2nd. We paid. So you have to kind of read the subtle differences in the text. When it says we paid rent, that means we paid cash. Okay? It didn't say we bought something on account. Bought something on account, there's no cash in that transaction. And next one now is July 3rd. Recorded $10,300 revenue for services rendered to patients, received cash of $4,200 and sent bills to patients for the remainder. Well, this is easy. We are looking for the impact on cash. So we look at that, and we should have cash going up by $4,200 because that's the only part of cash involved. So what we've done as we went through here, when we're looking for the impact of cash, I have the 3 dates on the screen. The top one, July 1st, cash went up by $60,000. July 2nd, cash went down by $4,700. And July 3rd, cash went up by $4,200. So the question says, okay, we want to know how much cash the company has. And it said use a T account. And we're going to see this in a minute coming up, but for right now I'm going to put the T account on the screen. Down in the lower right-hand corner, what you see is a T account. And the most basic fundamental part of a T account is indeed the T. So a T account is going to be the part going across here and then this part down the middle. And what you do, and that's why it's called a T account, because it is does look like a T. And a T account, we're going to do debits and credits in a minute here, but the debits go on the left and the credits go on the right. When we're talking about the T account for cash, trust me on this, increases go on the left, decreases go on the right for cash. That doesn't hold true for every type of account, but for cash it does. So cash, we put increases on the left, decreases on the right. There's an extra stray line in here under the $60,000, and I can't erase it. I don't know why it's there. Just a random line. So we would have increases on the left. So we have the $60,000. We have, ignore the line under the $60,000. We have $4,200 under the $60,000, and then we have the $4,700 decrease on the right. So then what we would do is we would draw a line under it, and we would get the balance. The balance of any T account is everything on the left added up minus everything on the right. So the difference in this case is $59,500, and it goes on the side that's greater. So it goes on whichever side is greater. So we take $60,000 plus $4,200 minus $4,700. We get $59,500. The left side is larger, so that's where it goes. So we draw a single line, put it right under that single line. So again, there is one stray line in here, and I'm not sure how that crept in here. So we would have $60,000, $4,200, and that line under the $4,200, not the line under the $60,000. And we're going to see T accounts coming up here in a few slides from now. But that is exercise 2-3. Any questions? Because we're going into T accounts now and the next learning objective, but that was a nice little segue. A T account is a way to keep track of transactions affecting one account. It is a really easy way to segregate all of those things affecting cash, and it's a way to represent an account. It's not a formal accounting thing, but when you're doing accounting, use T accounts all the time. I still use T accounts when I'm figuring things out. T accounts make it easy to figure out. Well,
it shouldn't matter how you do the math, right? You can do all that addition with all the subtracting.
Right. If you have 10 increases and 10 decreases, you could add all your increases, subtract all your decreases, and then just put them on the side that's bigger. That's exactly right. Okay, I don't want to do that one. You didn't put it up yet, did you? Okay, we don't want to do that one either. Let's just go for this next. Okay, so now we're going to be looking at T accounts. Okay, and we're going to be looking specifically at debits and credits. So now we get into the debit credit rules. And accounting is a double entry system. Every transaction affects at least 2 accounts. And every transaction, your debits will equal your credits. That is an absolute rule. If you get your debits, you know what your credits are going to total. Most of the entries we do, probably 75–80% of them, will be 1 debit and 1 credit, and they will equal each other. So let's just go forward here. Okay, so T account. Okay, so here's a formal T account. It is a record of increases and decreases in some accounts. Debits are on the left, credits are on the right. And I have to tell you, a few years back, he's retired now, but there was a professor here. And I'm not an entertainer, and I could never tell jokes or anything like that. But every day when he would introduce debits and credits into class, he would bring pom-poms, you know, like cheerleading pom-poms. And he would do this little thing that I thought it would be really cool. I should make you do this, Haley. You know what's coming up, don't you? He would do this, debits on the left, credits on the right, fight, fight, fight. So that's how you remember, debits on the left, credits on the right. But so debits will always be on the left-hand side of every account. T account, credits will be on the right. It doesn't matter what kind of account it is. That is one of those rules that's carved in stone. Debit is typically abbreviated DR. Credit is CR. I think the DR relates back to a Latin term, but I'm not going to test you on abbreviations, but in case you see DR and CR, that's what that is. And a T account is simply a way to illustrate an account. A T account at its most fundamental level is just a T, and after all the activity you draw a single underline, you put the account balance on whichever side's greater, and then a double underline at the bottom. And that's just the headings there. The debit and credit headings are not typically in a T account. That's just showing you debits on the left, credits on the right. Now, double entry accounting, there's 2 accounts. So this is an illustration of a T account, its most simple format. A T account has the account title across the top. We have the left side, the right side. All the debits go on the left, the credits go on the right. Okay, now, I have a debit credit reference sheet that becomes helpful. And I put the URL on the screen. It's at tiny.cc/debit-credit. It's also, I believe, on Blackboard on the home page. There's a debit credit handout. And this is kind of a rule sheet. And we're going to be, in this handout, and you don't have to have it, but you may find it useful. What I've done is I've picked step 1 when we're figuring out what's debited and credited in any transaction. We pick one account affected by the transaction. Then you have to say, is the account increasing or decreasing? And then what type of account is this? And this is where you have to identify whether it's an asset, a liability, equity, revenue, expense, or dividend. And then what do you debit or credit that account to increase it or decrease it? So that's just a handout. I just wanted to mention that as we go forward, that handout is available to you if you'd like to refer to it. And I think we've put some of those rules on the exam sheet, right? Okay, large part of this. Okay, just as a side, I'm going to skip ahead. For your exam, I provide you a sheet for use on the exam where I put down equations or things that you don't have to memorize, and a large part of this sheet is on there. If you're ever curious about what's on that sheet, you can click on Exam Info on Blackboard, and the exam reference sheet is there, and that's the sheet you'll have for use during the exam. And so a large part of this is on there. Okay, so we're going to come back. I just wanted to mention that as reference, but we're going to use these rules now, and we'll just. Okay, so debit credit rules. Okay. If I had to pick one thing that is going to influence you the whole rest of the semester, it would be on this slide. Okay? This is one of those things that later today we'll say, well, how did you know that you debit this or you credit this? These are the rules. You actually only need like the top half or the left half because they're mirror images. Debits will increase assets, expenses, and dividends. Debits decrease liabilities, common stock, retained earnings, and revenues. And then the opposite is true as well. So I'm going to pause for a minute because this right here is so key to everything else this semester. Every journal entry we figure out is going to go back to these basic rules. Okay, so these rules are fundamental the rest of the semester. We do a journal entry. How do I know that I'm going to debit cash? It's because cash is an asset and something just increased. So we're going to use these rules. I'm going to leave them now, leave this screen, but we will be using them everything we do, okay? So as an example, you haven't loaded this question, right? I'm not putting this question in Learning Catalytics. I'm simply going to say, which of the following statements about the rules in debits and credits is correct? When we look at this question, which is not in Learning Catalytics, and assets increased by a debit. I just wanted to show you the kind of question that I can ask about those rules. So knowing these rules, you can get through a lot of questions like that. What's increased by a debit? What's increased by a credit, etc. And this is all based on the double entry of accounting system. My battery in my clicker is going, so it's taking. Okay, so let's go through and use these accounting debit credit rules to do a journal entry. So now we're going to do journal entries. We're going to do 3 of them in a row, kind of as an example. We have a transaction. Jones Company pays $600 for repairs to a drill press. What's the journal entry? So what's happening here? Well, first of all, they pay $600. So they pay $600. We have cash decreasing. What's the other side of this? It would be, I'll answer for you, it would be repairs expense. Okay, they're just repairing something, so it's expense. So I have an expense increasing and I have cash decreasing. So when I go back to my rules here, I have an expense I'm going to debit. So, because the expense is increasing, and I have cash, an asset that's decreasing, I'm going to credit cash to decrease it. So this journal entry that we're doing, this is a journal entry. What I've got on the screen right now is a formal journal entry form. We're not going to typically use the form for most of it. But a journal entry has usually a debit on the left-hand column. And in real life, absolutely, every single journal entry has a date. You have to be able to cross-reference it. So you would have a date in real life in that first column. And then you have a column that holds the account names. So you're going to have account names. You're going to write what account it is. In real life, we have something called a chart of accounts, which gives us a number for the account because people could type cash so many different ways. So we have a number that we use for different accounts. But companies have chart of accounts that tell them what account number things are. But we have accounts, and then we have a debit column and a credit column. So a journal entry takes the form of the debit. The accounts that are debits are always listed first. The accounts that are credited are always listed second. So I'm going to put this journal up and then we'll talk about the different parts of it. Okay, first part. So first part of this journal entry, May 5th. That's assumed date. Just where did I get the date? I made it up. So May 5th. We have repairs expense. We always list all our debits first. So our debit entries would go first. So repairs expense, the $600 goes in the debit column. Okay. Now, next, every journal entry's debits will equal credits. So if I didn't even know what account went next, I know what's going to come next. In the credit column, I'm going to have $600 in that next line. But what I'm going to do next is I'm going to credit cash. Now, something for you to note, it's very subtle, but it's very important. That credit is indented, okay? There's an indentation of a few spaces. So debits are on the far left, credits are indented. A credit not indented is not a credit, okay? It has to be indented, and then it goes in the credit column. So when I'm all done, my debit column will equal my credit column. These entries that I'm starting with will just have one debit and one credit, but it's possible we could have a couple debits or a couple credits. But at the end of the journal entry, all our debits have to equal all our credits. Okay, now let's talk about these, why we debit and why we credit what we're doing. We paid $600. So in plain English, what we're doing there is we're decreasing cash. Cash is decreasing, and we're increasing repairs expense because we paid for a repair. So going back to my debit and credit rules, I'm looking at my debit and credit rules. To decrease an asset, which is what we just did, we credit it. Cash is an asset. To increase an expense, we debit it. Okay. What I find, okay, I think this is good to talk about. I like to think about cash. Number one, I like to talk about cash because it's easy to visualize what's happening. If you memorize any rule at all, debits increase cash, credits decrease cash. And the first thing people will say to me is, I get my bank statement and they say they credited my account and that increased it. Well, there is a reason for that. Okay, let's say your bank, your bank, so your bank does accounting, okay? They have accounting for everything that goes on. When you take $100 into the bank and open up an account, okay, so you give them cash. So let's think about what's happening to that cash from the bank standpoint. From the bank standpoint, their cash is what? Increasing, right? They're getting $100. Now, your savings account that you just gave them the $100 for, that $100, they're going to increase cash. What other account type is involved there for the bank? Is that an asset or a liability for the bank? Liability, right? Because your checking account or your savings account is a liability on the bank's books. Because you give them the cash, cash increases, but now they owe you money. And they have to pay you money whenever you present a withdrawal slip or make an ATM withdrawal. So that's a liability for them. So then looking at the debit and credit rules, look at the liabilities. For the bank to increase your account, it's a liability. To increase a liability, they credit it. To decrease your account when they charge you service charges, they debit you. So when they send you your bank statement or they send you a note and say, we credited your account and they increased it, absolutely they did, because that's a liability to them. That is not an asset. So that's the thing you kind of have to break your thinking on, that when we're talking about an asset, if we're talking about cash we own, we debit it to increase it, credit it to decrease it. Bank statements, when you think about what your bank does, that they're telling you what they're doing from a liability standpoint. That is a liability. Your account at the bank is a liability to the bank because they owe you the money, And so to increase it, they credit it. To decrease it, they debit it. So it's exactly opposite of what we're doing here. So this journal entry then, we're almost done with the entry. We're not done quite yet. We need to make a memo line. A memo line is an explanation for what went on in this journal entry. It down the road, whenever we record all these things, down the road, the auditors are going to come in and they're going to check to make sure we recorded things properly. And we need to be able to explain what each item is. So this first chapter or two, you'll see a lot of memo lines where it's required a memo line. And you do need to do them if they're required. Later on, we might not have memo lines, but that's what that last line is. So this is the journal entry. We have the date, we have the debit all the way to the left, and then we have the credit that's indented, and we have the debit and the credit in column. Notice we don't typically use dollar signs in the columns for debits and credits because it's known that those are dollars. Ahead here. We're doing normal balances in a little bit. Haven't introduced that yet. Okay. So let's do another journal entry. Okay. So if Bourne Company buys a new machine for $8,000 cash, what's the journal entry? Okay. So we buy a new machine for $8,000 cash. So we think about what's going on here. When I do it, I say, is cash involved? Cash is involved. So from a standpoint of what's happening to cash, cash is decreasing. So I know my second line, not my first line. Debits are always listed first. But my second line is going to be indented. It's going to be cash, and it's going to be in the credit $8,000. Okay? So once I do that second line, then I know I need a debit for $8,000. And the debit, what did we get for $8,000? We got a machine. So it's going to be some kind of property, plant, equipment. So we'll have equipment for $8,000. That's an asset. To increase an asset, I debit it. Then I indent, and I have a credit to cash. And then I have that memo line for purchased a machine. So when I look at this, I increased an asset, equipment, because I debited it. I decreased an asset, cash, because I credited it. So the net effect on assets cancels each other out. But it does not cancel. It is very important that we know how much cash we have and how much equipment we have. So we record the journal entry. If your Wi-Fi connection, are you going to do that call connection? Go ahead. Yes. You won't. The question is, if we have to do this on a homework, is the memo line always in italics? I think it is, but you won't need to make that distinction. You'll just pick it off the drop-down list. You won't have to choose between, yeah. Okay, we'll do one more journal entry and then we'll go on. Okay, so Seifert Company buys office supplies on account for $4,000. What is the journal entry? Oh, the question is in an actual accounting journal, will the memo line be more specific? It depends. It depends on the conventions of the company. Usually you'll have a cross-reference to where this document is stored. It'll cross-reference to a purchase order. It'll say invoice number or purchase order number. So we'll have more specifics. Yeah, it won't get really long, but it is short. And I'm answering these questions now. I'll take that one too. Will you ever have to take the depreciation of the equipment when you are factoring it into your assets? Yeah, we'll deal with depreciation a little bit down the road. Right now, we don't need to worry about depreciation in this chapter, and let's just leave it off the conversation for now, because we are going to worry about depreciation, but not right now. Okay, so if Seifert Company buys office supplies on account for $4,000, what's the journal entry? Well, first of all, we look at what's happening here. We're getting office supplies. So office supplies is increasing. Office supplies is an asset. So to increase an asset, we're going to debit it. So we will be debiting office supplies. And then the credit. because we know it has to be a credit, right? Because we have a debit to office supplies. So our credit is going to be to, we see on account. Those magic words, on account, means it has to be accounts payable or accounts receivable. Accounts receivable is our customers. This doesn't deal with our customers, so it has to be accounts payable. We owe it. So what we're going to see in this journal entry is we will see office supplies being debited for the $4,000. And again, I just made up the date. Our credit is going to be to accounts payable. Okay, so we're getting office supplies, which is an asset. That's why we debit it. Our credit, when it says on account, that's going to be accounts receivable, accounts payable. Accounts receivable has to do with our customers. If it's not our customers, then it has to be accounts payable. And we know it has to be credited for two reasons. Number one, because the rules say if we increase a liability, we credit it. But the easiest way to know it's a credit here is I know the first line is debited, so this one has to be credited. Our debits have to equal our credits. So if you get one side correct, the other one kind of pops out. And then we would have a memo line for purchase supplies on account. Yes. No, it does. Debits always mean increasing if you're talking about assets, and credits mean decreasing if you're talking about assets. But if you're talking about liabilities, it's different. Yeah, yeah. Accounting equation? Right, right. And so that, yes, you're very right. The accounting equation always stays in balance as well. You'll always have assets equal liabilities plus equity, and that will have that same impact. Okay, now we're on to this next process. So what happens during Okay, so what happens is during the month or during the quarter, we have transactions. We record those transactions. We record those transactions in journal entries. They go into a journal, okay? So we have this long list of transactions that happened. Now the next step, and this is part of the accounting cycle, so things happen, we record our transactions, and then we record them in the journal, and then we come to the end of the period, or during the period, we have to take those entries that are in the journal and post them to the accounts. And that's what we're talking about in this one. Okay, a journal is a chronological record of transactions. Oops, that went kind of fast. If you've got time, can you look and see if I have another clicker in there? Because I'm going to have to switch. Okay. So the journal holds the journal entries that we write, and it's this chronological record. Oh, yeah. Thank you. Okay, that one works better. Okay. Okay, so a journal is a chronological record of all our journal entries. So somehow we need to get the journal entries into the account, because it's interesting to look at a list of all our journal entries, but what we're really aiming to do is know how much cash we have, know how much accounts payable we have. We need to know how much we owe, how much customers owe us, so we need to get those transactions into the accounts, and that transaction is called posting. So that's another new word. This process of taking the transactions from the journal entries, putting them into the account, is called posting. And so this is an example of posting to the accounts. So we're representing accounts with T accounts. In real life, accounts exist in records, electronic records somewhere. In days before computers being prevalent, The general ledger was represented by a whole series of cardstock cards in many companies, and each card had an account name on it. So your deck, you would have a large deck of these cards. They would be big cards, and they would say like cash at the top, and then every journal entry we had for cash would get posted to that card. That card would have space on the left for debits and space on the right for credits, and you would just keep posting those to those cards, and then at the end of the period you would get a balance of each card. So that was this process of posting from the journal entries. So what happens here? Let's say we have a journal entry. This is just a sample journal entry. We're debiting cash. This is Exhibit 2.9 in your book. We're debiting cash and crediting common stock. That's when we issue common stock, we get cash, we issue common stock. So when we post to the account, we're going to take, first of all, that debit, that cash debit, and we're going to put it in the cash T account. Remember, in a T account, debits are always on the left, credits are on the right. So it doesn't matter what kind of T account it is, debits are always on the left, credits on the right. So then we're going to post that common stock to the credit on common stock. Okay, so we would do that for every single transaction during the period. And then you can see what happens is cash will get a lot of entries in it, land will get entries, accounts payable, common stock, all these accounts have the entries posted to them. So then at the end of the period, you get the account balance, and you get that by adding up all the debits in account, subtracting the credits, and putting the total on whichever side is larger. Okay, so this is this process of posting. So when we look at what happens, this flow of accounting data, this is part of the accounting cycle, the transaction happens, and then we analyze the transaction. All we're saying there is what increased, what decreased, what went on here. And then we enter the transaction in the journal, meaning we write the journal entry, and then after we write the journal entry, we post the journals to the ledger accounts. Now the ledger accounts, that's where this whole group of all our accounts, it's all our assets, it's all our liabilities, it's all our equity accounts, that whole thing collectively is known as the ledger. Now, so in chapters 2 and 3, we cover something called the accounting cycle. So you kind of have to step back and look at it. The accounting cycle is transactions happen, we analyze them, we write journal entries for them, we post the journal entries to the ledger, and then what we're going to do, the very next step is at the end of the period. So the last day of the period, what we want to do is we want to make sure all our debits and credits have been posted correctly, that everything's ready to go for financial statements. So what we do after this step is we prepare something called a trial balance. Okay, so with the trial balance, this is the last step in the chapter. A trial balance is not a financial statement. It is simply a listing of all our account balances. So the transactions have occurred, we've written the journal entries, we've posted the journal entries to the accounts, and now we have all the balances of our accounts, we list them in a trial balance. And a trial balance is all our accounts just in a plain list. And the assets are first, the liabilities, equity accounts. There's a specific order we'll show you coming up here. The first account is always cash. It's that same order like on the balance sheet. We do our most liquid to our least liquid assets, and then we do our liabilities. The trial balance, the purpose of a trial balance is to show that the debits equal the credits. Okay, that's the purpose of the trial balance. The trial balance is not a financial statement. We have 4 financial statements, and this is not one of them. This is simply a tool to make sure our assets equal our liabilities. I mean, that our debits equal our credits. So we're making sure our debits equal our credits. This is typically done at the end of the period. A trial balance is typically used then to start preparing our financial statements. And we're going to see that in Chapter 3, we have a couple more steps after we prepare this initial trial balance. But this initial trial balance, we're just making sure our debits equal our credits. Okay. And I referred to earlier, every company has a chart of accounts. This is not something to memorize. Okay, this is not a memorizing thing at all. A chart of accounts, but you should know what it is. A chart of accounts is a listing of all our assets, liabilities, equity accounts, and then typically the account number. And it's unique to each company. If you ever buy Quicken or QuickBooks, it'll give you a standard chart of accounts. You'll pick what kind of industry you're in. It'll give you a standard chart of accounts. But it's easier to refer to in real life account numbers than account names, because what happens is people, if you did account names, whoever's posting could type it differently, put a space in, not put a space in, so then you have a mess. So you just use account numbers. And account numbers here, there's 3-digit account numbers. Here at the university, I think we have something like 15-digit account numbers. So we have assets, liabilities, equity, but a chart of accounts is simply a listing of all the account numbers and names that are available to be used when doing journal entries, not to be memorized. And then normal balances of the accounts, I've listed the normal balance. Normal balance says this is what side usually that T account balance is on. The shortcut to, instead of memorizing something yet something else, the normal balance of an account is whatever increases it. So if you go back to the debit credit rules and you see all those whatever increases an account, that's its normal balance. So if a debit, so cash is increased with a debit, so a debit would increase cash. Next, I'm going to go through a trial balance. There's a homework exercise, and this homework exercise is a quick trial balance. So we're going to go through this. So again, normal balances of an account, if you want to refer to it later, it is Exhibit 2-14 in your textbook. But the normal balance of an account is whatever increases that account. So normally assets have a debit balance. Normally liabilities have a credit balance. Common stock credit, retained earnings normally credit, dividends debit, revenues credit, expenses debit. So when you list a trial balance, your assets are almost all typically debit balances. The liabilities go in the credit column, so you'll see it. We're going to do one here. Yes, whatever a normal balance is, whatever increases an account. That's its normal balance. There can be exceptions, but the normal balance, given no other information, you would put it on that side of its normal balance. Okay, so 2-9. 2-9 is a trial balance exercise. What we're given in 2-9 is we have a company and they've given us a list of accounts. Now notice these accounts, they don't tell us if these are debits or credit balances. We have to rely on what a normal debit is and a normal balance is for an asset and liability. So we see that we have other liabilities. And so right off the bat, I can mentally note other liabilities are credit, that's a liability. Other assets are assets, so that's a debit, normal balance. Expenses have a normal debit balance. Stockholders' equity has a normal credit balance. Revenues have a normal credit balance. Cash is an asset, so it has a normal debit balance. And finally, accounts payable is a liability, so it has a normal credit balance. So we're asked to prepare a trial balance. So a trial balance is a listing of the accounts in order. In order, it means it starts with cash, goes through the rest of the assets, then goes to the liabilities, then goes to the equity accounts, meaning the equity accounts, and then revenues, and then expenses for this one. And so we're going to list them. So then it also asks us questions. So what we're going to do, and just by magically clicking here, I'm going to have the trial balance. Okay, so trial balance. What I've got is I've got the name of the company, the name of what I'm doing a trial balance, and then it's as of one date and time. A trial balance is saying, here's how much I have right now in these accounts. So I list the account, I have a debit column, I have a credit column. So I go through that list and I put these things in order. So the first thing I found was cash, then other assets. I'm going to wait for a minute while you copy it down, then I'm going to say some things about what's going on here. I mean, it all has to do with the accounting equation. If you're thinking about what makes something a normal debit balance or normal credit, it has to do with the accounting equation. You have assets which have a normal debit balance, so that's on the left, equal liabilities plus equity. Liabilities and equity have a normal credit balance because they're on the right. But then within equity, revenues increases, so that's a credit. Expenses and dividends decrease it, and that's why they're debited because they offset. So it all goes back to this accounting equation, but if you don't want to deal with that, just know that those normal balances are whatever increases in account. Some things to note about the trial balance then. We have the name of the company first. The second thing is, what is this? It's not a financial statement, it's a trial balance, which the purpose of a trial balance is to make sure your debits equal your credits. And then the date. And then we have a list of the accounts. They are in order: assets, liabilities, equity. Cash is always first, so order does matter. And then we have a debit column and a credit column. So we put accounts in their normal balance. So we have the cash and other assets are both normal debit balances. Dropping down to expense, that's a normal debit balance. We do a single underline, do the total of that column, and we get $52 as the total, and we have a double underline. That doesn't show up real clear, but that is a double underline. So we put the total in a single underline above it, the total, and a double underline. In the credit column, accounts payable and other liabilities have a normal credit balance. Stockholders' equity overall has a credit balance. Revenues have a normal credit balance. So we put those, single underline, add those numbers up in the credit column. We get $52. And again, so our trial balance is said to be in balance. Our debits equal our credits. If it wasn't in balance, there are some things we can do to investigate errors. Your book lists 3 types of errors. You should probably give that a read. It's talking about, well, maybe you debited something instead of credit and you're off by that, and there's ways you can look for your errors. We'll see that more in Chapter 4 as well. Okay, and then the question asked, what was the company's net income, I believe? Yes. How much was First Mortgage Company's net income or net loss? Well, to get my net income or net loss, okay, it's going to be my revenues minus my expenses. That's it. So my net income, it's always revenues minus expenses. So 38 minus 27 is 11 million. So to answer that question about what's their net income, it's revenues minus expenses. Okay, and then we're going to do a question to end up here. Okay, question. Accounts are listed in random order in a trial balance. True or false? This is our last question for today. So once you've answered it and you've made sure that you've entered your answer, you are free to pack up and leave. We're going to be putting the answer up in just a minute. So you have about 10 seconds left to answer. This is just a true-false question. So get your answer in. Any questions while we're waiting for this to close? Okay, I will be sending an email out this afternoon with some links to videos for some of the homework problems that we didn't do in class. So if you understand this, great, you can do the homework. If you want more help, those videos will be available to you. Chapter 2 homework is due this weekend, and I'll see you on Monday. And we're going to close this now.